Hello. I am here today with Phil Hill, the founder and CEO of Phil Hill and Associates. Phil has a long background in the edtech industry as one of the folks that I go to for both present day, what the heck is going on in the edtech market, and also education history and how this industry formed over the past 20 odd years. One, Phil, thank you for the work that you've done educating me as I've grown in my career. And thank you for the work you've done on this anthology um, bankruptcy. I wanted to say saga, but at this point it's bankruptcy. It's and
Yeah, it's
we're
both.
yeah, exactly. And you know, we will get into the specific details of the bankruptcy, but before we do that, can we just establish like where Anthology came from, why this is feels meaningful in the broader edtech context, just as much as it does in this specific financial transaction?
Sure. Well, I mean, the longest term part of the business is Blackboard. That was the last big acquisition, but we'll start with them. Blackboard was one of the original LMSs. They came to dominate the LMS market in the 2000s, but even when they weren't dominating and winning everything, they dominated the market because so many people were reacting to them, the
Yeah.
rise of open source, the rise of Canvas. So it's been not just what they provide, but they're sort of what people talk about when they talk about the LMS market. And they've gone through their ups and downs, going public, being taken private, et cetera. On the other side, you had campus management and campus labs. And campus management was student information system, but mostly in the for-profit space. And those got rolled up when Veritas in particular purchased them, and they created Anthology, and they took three of these enterprise type companies. Then after they did that in 2021, they acquired Blackboard and rolled it into Anthology. So by 2021, it was a combined company that had student information system, had a CRM, had an LMS, had student success. So it was sort of a broad, and it represented at least a lot of the functionality of the market. They never dominated like we're the biggest or most popular system, but so it's an important story. And I think what we'll get to, part of the importance of the story is also the whole PE ownership, private equity ownership, and what's happened from there. So it got there by doing all these acquisitions, hence the name Anthology.
Yeah, and I just want to double down on the like Blackboard's place in edtech history because I think honestly when a lot of people think about edtech, they think about the LMS and MOOCs and Blackboard is sort of a what's the word like what Kleenex is to tissues.
Yeah, yeah,
There's
yeah. Brand
the
representation, but there's something more
exactly
pithy there. Yeah,
exactly. There's some fancy word for it, but
yeah.
you know, people know the Blackboard brand even outside of the education industry. And I think what's sort of interesting in Blackboard's history, and before we get to the anthology constellation, is they were built largely on the back of roll-ups, right?
Yeah,
And that those roll-ups were financed to be in a lot of different ways, from venture capital to public money. When they went public,
yeah.
they used a bunch of uh, the money they raised to then go buy other companies. And you have your famous LMS squid diagram that
Yeah.
sort of shows the number of vein of tentacles of the squid
Tentacles.
going
Yeah.
into that go into Blackboard. So it's sort of funny that it's a strategy that is not unfamiliar to Blackboard, but went wrong in this specific context.
Well, it was different in terms of early Blackboard. Well, first of all, they became the market leader organically, but then they quickly turned to M&A to grow as a company. And most of their early, not all of it, but a significant portion of their M&A was buying competitors, buying WebCT in particular, that was the number two competitor, and they had to get a DOJ antitrust exemption. They bought Angel Learning, they bought Moodle Room. So they were buying competitors both to buy the customers, but also, they had desire to combine platforms as well, but it really became the customers. That's different than Anthology, that's more of a horizontal, let's pick different pieces and see how they fit together. But having said that, you're right. There is a certain irony, live by the sword, die by the sword is one way to look at it. But it's also the emotions behind it, because so much of the market still has a deep memory of what Blackboard did in the 2000s. They are very free to immediately think that when they hear things such as Blackboard getting acquired, Blackboard declaring bankruptcy. So the market's just primed to react to
Yeah,
this news.
totally, totally. And I think it bears mention that a big part of the reason for the thesis behind the roll up, the anthology roll up, is the LMS market has reached sort of a state of maturity. Most universities at this point have an LMS.
Yep.
So I'd be willing to bet that the rationale for the horizontal integration that you just talked about was, well, there's not that many LMSs left to buy, right? Instructure obviously is a major player. They are also owned by private equity now. And I would, pay a lot of money to be a bug on the wall of KKR's boardroom right
Yeah.
now, thinking about what their next move is and what their own thesis means coming out of this. And then you have Moodle, of course, which has the open source format. That I think open source is going to be one of our topics here. And Blackboard, and then some other. You've got some corporate
Well,
LMSs.
I would throw
Oh,
D2L
D2L,
in the
yeah,
mix because they're really
yeah,
number two in terms of new wins.
yeah. And uh, the point I'm trying to make though is that you don't have these big swings in market share or new opportunities to grow available in the LMS space.
Sure.
It actually is sort of remarkable how big Instructure was able to get, sort of taking share for most of the 2010s. Um, so it's and this is all sort of written in hindsight, right? Of like, if I think back to 2021, I wasn't writing my newsletter quite yet at the time, so I didn't get a chance to write about this and be wrong. But I think I probably would have said, like, I get it. I sort of
Yeah.
get the thesis of like, yeah, I don't know that there's much left to like just keep building in the LMS space. Why not go horizontal?
Yeah.
Uh,
Well, I took the opposite tack as that I almost immediately wrote that the acquisition was a mistake, not because of the market saturation. This was, I think the fundamental flaw was this was an acquisition that made a lot of sense in a white paper, but not in reality. And just the fundamental economics that you have different buyers. You're doing an ERP, you're talking about the registrar, you're talking about the CIO. But when you're talking academic in the LMS system, you're talking faculty committees, associate provost, and they're the people who own and make that decision. And the CIO is in a supporting role. But not only that, there's such sort of antagonism between the different sides. Faculty groups, quite often, if you came to them and said, oh, you should use this LMS because we already use this SIS and the CIO chose it, that would be a reason for the faculty to say, no way, we're going differently. So just fundamentally a different buyer for it. And that broke down that white paper assumption behind what Anthology tried to do by the acquisition. So I'm actually on record saying it was a mistake from the very beginning, for that reason. But you're right about the market saturation. There's always a need. We're in America. There's a need to grow, right? So what are the vectors for growth? Well, in the North American market, you really can't grow that much by market share because it's a zero-sum game. And so you look for other approaches. And I think that's what led them to do this acquisition, which is, I think it started showing that it was a problem for very early on for that reason. And then if we get into it, debt and interest rates is the other reason.
yeah, and I do want to go there, but I just want to like, and you talked to me about this a couple weeks ago at Hold On IQ, and I really appreciate the perspective of it is a sort of white paper, PowerPoint slide thesis of like, well, if you can't keep growing up, you just grow out.
Yeah.
And And that point about the different buyers, there really isn't, I think it, again, sort of a white paper thesis of like, well, if we have a relationship with the university president, well, they might buy multiple items for us. And the reality on the ground is that's way harder to pull off than it sounds on paper.
Yeah, I think I made the point that this makes sense for a handful of private schools where truly a unified decision and the president involvement makes sense. It makes sense with some universities in Latin America. And I think the way I phrase it, for the other 95% of the market, it just doesn't make sense. So there are cases where I think it has worked out. But by and large, it hasn't.
Yeah. And I think the moral of the story is like really take the time to suss out who your customers are and
Yeah.
understand that like selling to these different groups is a fundamentally different practice. And
Yeah.
you might get marginal synergy, to use the famous business word, but it's really tough to make it a thesis. Now and let's talk about the debt, because I think
Sure.
my rebuttal, which is more of a straw man than a steel man, would be like, oh well, really what data Anthology in is they got bought at the top, right? 2021 was peak EdTech. And there's a million different data sources that will sort of corroborate that statement. And it's just bad timing. Like maybe the thesis would have worked if they had bought in 2019. So I'm not sure I actually believe that, but I think it's worth.
But that peak ed tech also relies on the assumption that the market was not going to ratchet back once the pandemic was over. In other words, it was an inflated market. There were signs that people could have seen. But having said that, yes, I think the proximate cause of what happened is exactly where it's the peak valuation, but also in Q1, Q2 of 2022, the Fed funds rate goes up, and so the cost of borrowing goes up. Therefore, the debt servicing just completely changes what's happening there. And it changes your prospects as a company to refinance that debt down the road. Because a lot of companies get addicted to that. Oh, we'll raise money. Oh, when the bonds are due, we'll refinance again. And pretty quickly, 2022 happened in 2023, and the answer was, you're not going to be able to refinance this. So I think
their ability to sell, their ability to sell and or bring on additional financial sponsors, I think, declined rapidly, right? And again, this is speculation, but I wouldn't be surprised if the move to bankruptcy was less a specific need and more a reading of the tea leaves that like help was not going to come. And I think the past 6 months have been the company's leadership and their financial sponsors doing a roadshow trying to figure out like, how do we get people interested in this thing so that we don't have to go through bankruptcy. And they just couldn't get out from under the weight of,
One thing that from the court filings that has become more apparent is really December 31st, 2024 is when they skipped interest payments, and that triggered this process that you just described. What can we do? Are we going to get out from underneath it? But the filings make it very clear that they were aware of the problem in late 2023. And so they already had done things. They did a lot of cost cutting, a lot of layoffs and restructuring. And it mostly carried out fairly well it's a harsh subject, but I think they did a good job. But the other thing is they got sort of that intermediate financing in May of 2024. That extended the runway deep into 2025. So in other words, there's sort of a longer running, how are we going to deal with this? What can we do? And really the activity in 2024 then culminated by the very end of the year when it's like, well, we know we can't do it. So there was an agreement to skip interest payments. And that really started the clock ticking, a multi-month clock. But then they tried many ways to get out, to not go into bankruptcy, and just couldn't.
Yeah. And they're, their financial sponsors effectively threw in the towel and said,
Yes.
yeah,
Well, it was so
the debtors
clear. If
can,
you look at the numbers, they were the equity owners. Veritas was going to get nothing. And sorry, I said Vista Equity earlier
no worries.
in the interview. I meant Veritas, but it was very clear they were going to get nothing out of the deal. So it was pretty much, okay, let's try to help people make a transition, but we're not really negotiating because we're not going to get anything. So you're right. They threw up their hands, but they've been cooperative, I guess is the point I'm trying to make. Even though they're not expecting to own anything, they have cooperated in this process.
Yeah, on some level, it's probably better to get out of the asset rather than
Yeah.
riding it into the ground.
Yeah.
I also think what's interesting and consistent with the fact that the thesis was just as like the error in the thesis was just as important as the debt is that their restructuring as part of the bankruptcy is going to include disaggregating most of the assets.
Which
So
points the thesis, yeah.
exactly. So maybe if you don't mind, do you want to just lay out how they're thinking about that disaggregation and then talking through, maybe some thoughts on where the different assets, like, are they going to be more viable now? It might be a little early to make that prediction.
Well, I think there's a big variable that we need to go, and that's the distressed debt investors,
Yeah.
Nexus Capital and Oak Tree Capital. These are companies that specialize in distressed debt and timing.
And
They get
EdTech folks will be familiar with Nexus, right?
They own Savis, which is essentially they bought the Pearson K through 12 asset. So that's where I assume most people would know them from if they do.
Yeah.
But when they got involved, things changed, and that was in the spring. They started, buying up the bonds. But the reason I mentioned this based on your question is the management team did not change their thesis. I don't believe that Veritas, even though they threw up their hand, they hadn't changed their thesis. And most of the long-term debt investors, the ones I've talked to, hadn't changed their thesis either. What happened is you got these people involved who specialize in this, and then it became a matter of maximizing the investment through debt management. Well, it turned out the best deals they got were to separate the SIS enterprise, sell it to Ellucian, the two stalking horse bids, and then the CRM and the student success stuff and sell that to Ancora. But that wasn't made because they changed thesis. That was made simply based, in my opinion, on what bids they came in and what they were thinking about. So it's broken the thesis, but I don't think it was a deliberate...
Sort of inadvertently.
Yeah, exactly.
Yeah.
Financial realities overtook strategy.
Gotcha.
And I'm not saying that's wrong. I'm just saying I think that it wasn't a considered decision by management saying, let's reevaluate our strategy and change course.
Yeah. And one thing I just want to dive in on, because you brought up Ellucian, who's taking on the SIS portion of Anthology's business, is, and we talked about this a little bit yesterday too, of they were bought out at the same time as Anthology, and they used a vertical thesis. So they've added a couple of mostly sort of back-end SIS and SIS-like functionality since that transaction. And at the very least, they were buyers in this scenario and not sellers. So, it's obviously hard to predict without more information how well that transaction is going, but they're not facing bankruptcy and are buyers. So presumably at least a little bit better.
They do have a large debt, like $3.2 billion of debt. And so they're certainly not in the distressed debt bankruptcy area, but it certainly is something I would keep my eye on, or put another, I will be keeping my eye on. So, but yes, much stronger position in the market as well, like their product line and what people look for. They have much greater strength in that area as well. It's not just it's both aspects that they're stronger in.
Yeah. And I think, again, it gets to sticking with one buyer versus trying to sell a lot of things to many buyers, and the difference in thesis, I think, matters. I also you touched on this a little bit by saying they do have debt, and I think the role of private equity in this whole process is something you and I have gone back and forth on a little bit, but haven't really like sort of met head on yet. And
Let's have at
so so, I think I probably am a little bit more pro private equity or pro debt maybe than you. Can you just lay out some of your concerns for why, in this case, I think it certainly led to some bad consequences and schools will be
yeah.
affected, but sort of the macro level of your concerns about the role of private equity in this part of the ed tech world?
Well, keep in mind my role. I mean, since I've been writing the newsletter for so long, my primary thing is to describe what's happening, whether I agree with it or not. So,
Sure.
given that, that does influence me somewhat. But I'm against the usage of debt. I've seen cases. I mean, as a matter of fact, Thoma Bravo and then KKR have really done a lot improving in structure since they acquired them. They were nowhere close to profitability before when they were on the public market, and they've got things organized better. So that's an example. I do see the value of debt when you do it the right way. My biggest criticism of debt recently was the flurry of 2021 in particular, where people just assumed the sky's the limit. The ed tech market valuation is only going to go up and interest rates will stay essentially zero forever. It was those naive assumptions behind the debt that I'm most critical of. So go back to 2U. Um, well, actually, that's where you and I might disagree because the edX acquisition for 2U was during this
Cash.
period, and 800 million that had to be financed, and in this peak valuation. So very similar thing. But then they also borrowed close to 750 million before the pandemic to get
For
Trilogy.
trilogy. Yeah.
So I guess my main criticism is not you shouldn't use debt. My main criticism is the naive assumptions of 2020 and 2021 that have blown back on the debt, and that people can be too naive about what's going to happen in the future of debt. And we're seeing the reality of that right now. So I don't know if it's not completely different, I don't think, than what.
Yeah. I think it's different flavors, right? And that, I think my take would be that it's much more strategy driven. And when it blows up, it looks really ugly.
Yeah.
I think the, 2U edX had a similar sort of white paper thesis of, edX had 40 million subscribers or users in their
Registered
database.
learners, yeah.
Right. But it turned out, most of those, 70, 80, 90% of those were in markets that didn't support the high price degrees that were the bread and butter of 2U's business. So
Yeah.
it's like the dissonance between what you think you're buying and what you buy in practice, I think undid 2U and undid Anthology here. This was a difference in buyers rather than buying users, but
Yeah, that's an interesting case because I see a lot of similarities. What you just mentioned, it's a strategy question that doesn't pan out in reality. It was a matter of doing the financing in 2020, 2021 at peak valuations, and then having to deal with the reality of interest rates. And so there's a lot of commonalities. And then they both went bankrupt because of it. The thing that's different is 2U was able to do a prepackaged bankruptcy where they turned it over to debtors, but without having to sell off portions of the company. And so and they got through it in just a matter of weeks, they got through the bankruptcy process. So I think that's the biggest difference. Personally, I think that Brian Napak's role as chairman of the board and navigating that process was part of the reason that worked out. But so it's interesting to compare the two.
yeah, I mean, I honestly, I was more surprised that 2U didn't have to sell off some of their assets. And in fact, they just might not have had bidders for some of those assets, right? And
I was wrong. I predicted that they would sell off some of the assets, and I was wrong.
yeah. So, I think the moral of the story for me is like, it for the right reasons that can make sense. And structure is a great example. I think Cengage their bankruptcy was over 10 years ago at this point, but similarly, like, going through the LBO, the bankruptcy and then, buyout process, I think helped them clean up shop in a way that was just not going
Yes.
to happen. Otherwise, McGraw, I think, has went through a similar set of procedures in the 2010s. So when it goes right, it goes right. But when it goes wrong, it goes, unfortunately, exceedingly wrong. I think in some ways, what's interesting to me is just the magnitude of it, right? Where like these are billions of dollars.
Yes.
So I think that is what can grab me and might be what grabs other people is like, how do you run $1 billion company and still have this happen? But when you boil it down, it is, one decision or a couple of decisions that, make or break the companies, which is
Well,
sort of crazy.
but let's also be honest here that this is a hard ed tech is a hard market. I
Yeah.
think a lot of academics too often think, oh, it's lining the pockets of executives. People are just getting rich and it's easy money. This is a very difficult market, and so it's always difficult to say, well, how do you get to a proper size where the investment in R&D makes sense? How do you get to a sustainable company? And it's difficult in ed tech, and that's is part of the world that we live in. You have to find some aggressive or creative ways to grow. And a lot of the examples you just mentioned, I think, go along those lines. This is not an easy market. The other thing I will say from a Blackboard perspective, because I really like comparing to these other cases,
Yeah.
Blackboard, assuming, well, that's the remainder of Anthology will be Blackboard. It's going to be rebranded as Blackboard, by the way. They sold the Anthology brand. But when Blackboard comes out of this, they're going to have zero long-term debt. And I think most of the other cases, there was some residual debt with the company coming out of it. But in this case, the plan is to not have any long-term debt on the balance sheet when they come out of the process. I think that's somewhat unique as well, assuming they pull it.
Yeah. Yeah. That is surprising to me. Like I assumed they would get some sort of cash infusion.
Well, there's the short-term $50 million new money term loan, but it's debtor in possession financing, so it doesn't really roll over into existing debt. So it's complicated, all the financial games that go on. But coming out of it, with the filing plans have zero debt on the books when they come out of this, and I
Gotcha.
do think that's unique.
Yeah, well, and that helps get at one of the other angles that I wanted to talk about with you, which is sort of balance sheet power and
Yes.
how universities can de-risk their own operations using private company balance sheets, right? And
Yeah.
this is quite prevalent in the OPM industry, very explicitly so with rev share contracts. And I think it matters with LMSs too. And I saw one of the comments on your post talked about how, Blackboard customers might have been better off with open source solutions. And,
Yes.
I am open to the argument about that, but I would highlight that like going open source comes with its own set of costs, right? And that's why, really the only major US university on an open source platform is Western Governors University, or is transitioning. And they also happen to be probably the strongest balance sheet in the US university system that, endowments excluded, right? Like,
Yeah.
But I think there's something there too that I think often gets left untouched.
Well, one interesting piece of history. So Matt Patinsky, one of the co-founders of Blackboard, along with Michael Chase, and Matt Patinsky recently wrote a post that I published it on EdTech called LMS at 30, basically saying it started 30 years ago, the market, the ideas, and looking at where it went. One little nugget, I don't know if you noticed, is he was saying that that in his view, the academic LMS market sort of helped create the SaaS subscription pricing.
I loved that. Yeah. Because he said they did it just out of desperation.
Yeah, exactly. They were trying to see what sticks. And this is the thing that worked with customers. However, I think you just described why the customers reacted that way, even if it wasn't explicitly in their mind. It's essentially university leaders were saying, we're willing to pay subscription fees, which is saying we're willing to use your balance sheet to develop the technology, and we're going to rely on that for our virtual home. So really, his argument that they created the subscription business is a manifestation of what you said about using private company balance sheets to advance university operations.
Yeah. And I just think like, you know, it's really hard to run a university. You've got so many different cross subsidies all over the place,
Yeah.
from the hospital system to the graduate degree programs to the like everything is such a mishmash that it, you know, I'd be willing to venture that it would have been tricky for a university to take on building this kind of technology on its own. So I don't know. I that's you know, a side note in the discussion, but you know, I think
Wait, well,
is
actually, one
often.
more note. I don't think it's completely a side note because the University of Phoenix, which was the largest university in North America by far, they attempted to build their own custom LMS using their own balance sheet. And when they moved to Blackboard Learn Ultra in 2017, that was them saying, we failed at developing our own LMS and we need to take advantage of the market. So, and that was and probably has been the biggest Blackboard customer of the past 8 years. So it actually is still relevant if you ask me.
Yeah, and I think it all highlights like, you know, this is the complex market, the something that sounds easy. I mean, Instructure has its own open source kernel too. So
Yeah.
things that sound easy and the sort of immediate reaction of like, oh, you can't trust private companies. I sort of understand the emotion behind it, but struggle a little bit with the like, well, but when you think about it,
Yeah.
you know, you're just shouldering more of the risk yourself. And like, yes,
Well, part of the way I
unfor-
reacted to that comment, which was I appreciated the comment being made because it's led to a good discussion. But in the rise of open source in the 2000s, it was a different world. You didn't have cloud hosting, you didn't have a
that's true.
full-fledged
Yeah.
SaaS model. And therefore, it was a different set of dynamics. Well, the whole market shifted to the cloud. That's what university leaders want. They want cloud, they want reliability, intuitive interface. And it's a whole different set of market needs today. And I think open source is locked into what they did 20 years ago. They haven't adapted quick enough to say, you know, because if the argument is, hey, you should go back to the open source model that's not cloud reliant, then people aren't going to do that. It's a different
Yeah.
reality today. But if you said, well, go to open source with cloud, that is a viable alternative. It's just developing very slowly.
Yeah. And I'm curious to see if we get somewhat of a renaissance as we
Yeah,
get into the AI adoption
definitely
cycle.
worth watching. Yeah.
So, you know, I do like think there's a strong moral to the story of, you know, for university leaders and for company leaders who are trying to think about how to sell to university leaders, this whole like understanding the strength or weakness of your own balance sheet relative to the peers that you're competing against in a really mature market. We've had universities in the US for several hundred years. It's
Yeah.
about as mature a market as it gets. I think matters, and being honest with yourself again as as a university leader and a company leader about what your value prop is in relation to your partner's balance sheet.
Yeah. The whole vendor management is becoming more apparent and more important. And it's balance sheet, but it's also evaluating your partner's financial stability. You know, there needs to be a more mature partnership evaluation model moving forward. And not just, it's not like Anthology changed everything. It's just today's example. And as we said at the beginning, it's something a lot of people are talking about. And so I think it's good. Hopefully, will improve the field of higher education decision making on partnerships. Look at these important issues that we're talking about.
Yes, I wholeheartedly agree. And I also, I'm cognizant of time. I really appreciate your willingness to hop on. Obviously, this is still a developing story. I think we have more information on it now. I think we have sort of a future path charted. We'll see. There may be some bumps in the road or dark horse bidders, but I really appreciate your willingness to hop on and talk about not just like what's happening today, but putting it in context for how this market has emerged over the past 20, 25 years. So,
Yeah.
thank you.
Hey, well, thanks for the invite. And by the way, I never did think you'd be able to keep this conversation under 30 minutes. So I've enjoyed this.
Yeah, I think we touched on a lot of really important points. So, thank you for hanging with me.
Okay. Bye.